Welcome back to the deep dive. Today, we're really digging into some extensive source material, focusing on, well, the emerging new global financial order.
That's right.
We're trying to cut through all the noise,
Yeah.
manage headlines, especially this whole idea of a U.S.-China trade war. We wanted to look at what the financial players are really doing behind the scenes.
Exactly. The main sources we're drawing from today are a really detailed analysis by Simon Dixon. He's a Bitcoin OG geopolitical analyst from one of his recent live streams, and also a follow-up interview he did on the Capital Cosm podcast.
Okay.
And taken together, they really paint a picture, a kind of framework for understanding this huge global reset that seems to be happening right now. Our goal is to decode it through a specific lens, something the sources keep calling the proof of weapons network.
Right. That term jumped out immediately, the proof of weapons network.
Yeah.
It feels central to this whole thing. So what exactly does that framework mean? And maybe who's driving it?
Yeah, it's key. The sources use it as a kind of shorthand. Think of it like a fusion. You've got the financial industrial complex, the huge asset managers, private equity giants.
BlackRock, Vanguard, those types.
Exactly. Fused with the classic military industrial complex and the newer technical industrial complex. Think AI, big tech infrastructure. And this network, crucially, operates sort of above any single national government. It controls global policy because it controls the board seats of the biggest companies, the biggest banks.
So they dictate the flow of capital, essentially.
They dictate where the debt goes, yes, where conflicts are engineered, maybe where they're resolved, and ultimately how wealth gets extracted during this massive global shift.
Okay, so we're talking about a power structure that really goes beyond just nations.
Yeah.
And this structure, according to these sources, is executing a kind of managed pivot, a controlled demolition even.
And that's language they use.
So we got four big themes to tackle today based on these sources. First, how this network is, well, tightening its grip on Bitcoin.
Yeah.
Second, the mechanics behind what they call the controlled demolition of the petrodollar system. Third, looking at the U.S.-China trade deal, why it's not what it seems, more of a strategic reset.
Right.
And finally, why geopolitical focus is being deliberately shifted, manufactured almost, towards places like Sudan as a form of leverage.
It really connects all the dots, how the world's reserve currency system is potentially being dismantled, how a supposedly sovereign asset like Bitcoin is being brought into the fold, and then how the social consequences of all this are being managed. It's quite a picture.
Okay, let's dive right in then. All right, Bitcoin. We have to start here because the sources level a pretty devastating critique. They argue that after all the talk about digital sovereignty, Bitcoin users have kind of walked right into a trap set by Wall Street. They call it the original sin of this cycle.
It's a very strong claim, yeah. I mean, the whole point of Bitcoin originally was to create something outside the control of banks, outside the debt-based system.
Right. Financial freedom.
But the sources argue that somehow over 2 million BTC, a huge amount, have been willingly, almost eagerly, handed over to institutions.
Through what channels?
Well, primarily through the new ETFs, that's the big one, but also through other structures, things set up maybe for tax purposes or getting Bitcoin into your 401k retirement plan.
Okay.
And the argument is by chasing these, relatively small fiat benefits or conveniences, people are actually feeding the very beast they were trying to escape. They're empowering the debt system.
And the scale of this institutional capture, it's pretty shocking. BlackRock is mentioned specifically.
Yeah, the number cited is staggering. BlackRock alone holding something like 800,000 Bitcoin just through their ETF product.
800,000. I mean, if decentralization was the goal, this sounds like the complete opposite.
It's the definition of centralization, right? And this leads to this phrase the source uses, which is quite evocative, tokenizing your ass.
Okay, unpack that one for us.
Right. So what they mean is Wall Street, the financial industrial complex, or FIC, takes your actual sovereign decentralized asset, your Bitcoin, and turns it into a debt obligation. They securitize it.
So the ETF share I hold isn't the real thing.
You hold a piece of paper, a derivative, that gives you exposure to Bitcoin's price. But the actual underlying Bitcoin, the keys, the control, that sits with the custodian, like BlackRock, and they can then use that underlying asset to fuel their existing debt machinery. They control the network influence that comes with holding large amounts.
So I buy an ETF share thinking I've got Bitcoin, but really, BlackRock holds the keys to the kingdom, so to speak.
That's the argument. And beyond just the ETFs, the FIC has other ways of exerting influence, particularly on larger corporate players who got into Bitcoin.
Right, like the companies holding Bitcoin on their balance sheets.
Exactly. The source describes these Bitcoin treasury companies, MicroStrategy being the prime example, as, well, sophisticated financial weapons of mass destruction.
Weapons. How so? Isn't Michael Saylor just a big Bitcoin believer?
The analysis here is different. They don't see him primarily as a Bitcoin maximalist acting independently. They see MicroStrategy as accumulating Bitcoin for Wall Street, using massive leverage.
Okay, walk us through the mechanics of that leverage. How does MicroStrategy buying Bitcoin end up benefiting Wall Street?
It's a two-part strategy, basically. First, MicroStrategy issues corporate bonds, that's debt, to raise money to buy Bitcoin.
Okay.
Second, they sell MicroStrategy stock equity and use those proceeds to buy even more Bitcoin.
So they're borrowing heavily and diluting their own stock to stack sats.
Exactly. Which means the company is incredibly leveraged, and its huge Bitcoin stack is effectively collateral. Now, imagine a severe market downturn.
They could get margin call.
Or worse.
Or forced into Chapter 11 bankruptcy.
Yeah.
And if that happens, who gets first claim on that massive pile of Bitcoin? The creditors.
Which are?
The big Wall Street institutions that hold the debt. It becomes legally accessible to them.
Wow. And this whole structure is reinforced by something as simple as a credit rating. That seems subtle. It's the critical control lever, according to the source. S&P Global Ratings, one of the big three agencies controlling corporate debt access, gave these treasury companies a B rating.
Which isn't great.
It's not great, and it acts like a loosh. The implication is if these companies play ball, if they keep accumulating Bitcoin into the institutional system, keep encouraging retail towards ETFs,
Wall Street can reward them.
they can reward them with an upgraded rating, which means access to more debt, cheaper debt. It creates this cycle using Bitcoin as the bait to keep them hooked into the debt system.
Okay, but what if I'm savvy? What if I avoid the ETFs? I avoid these treasury companies' stocks. Surely the banks have another angle.
Oh, they do.
Yeah.
This is where someone like JP Morgan comes in, offering collateralized loans. And it's interesting, the source notes how JP Morgan, Jamie Dimon, they tend to avoid the word Bitcoin. They prefer the broader, maybe more controllable term, crypto.
So what kind of loans are they offering?
Loans backed specifically by Bitcoin ETF shares and also ETH ETF shares.
Why does it matter if the loan is backed by the ETF share versus, say, my own self-custody Bitcoin?
Because, again, it comes down to who controls the underlying asset. If the loan is against the ETF share, the actual Bitcoin, or in the case of Ethereum, the actual Ether, stays with the custodian like BlackRock.
Ah, and with Ethereum, that's particularly important, isn't it?
Crucial, because it allows BlackRock, or whoever the custodian is, to stake that underlying ETH.
Giving them network influence, voting power.
Exactly. They gain control over the consensus mechanism. Meanwhile, the investor gets a fiat loan, which just feeds back into the broader debt system. The individual thinks they've unlocked liquidity, but the source argues they've traded sovereignty for more debt.
It really sounds like a multi-pronged institutional capture strategy. Okay, let's shift from the private sector to the government itself. The sources talk about a pretty aggressive potential government strategy here, not buying Bitcoin, but confiscating it.
Correct. The claim is the U.S. government is actively testing the waters, testing the mechanisms for confiscation. They specifically mention tests involving another 100,000 BTC.
Confiscation. That sounds extreme. Is there a precedent?
The parallel drawn is stark and, historically accurate. The 1930s gold confiscation under FDR's Executive Order 6102 during the Great Depression.
Right, when citizens were ordered to turn in their gold.
The underlying logic, the source argues, is the same. When the debt-based currency system faces collapse, the state moves to claim ownership of the hard, sovereign assets held by the populace.
And those highly leveraged treasury companies we just talked about.
They're seen as the potential legal weak point, the vulnerability that can make large-scale confiscation easier down the line. If they go bankrupt, the state could potentially step in.
That puts the risk squarely back on the individual holder, even indirectly. Okay, let's connect this asset capture strategy back to the existing dollar system via stablecoins. They're described as a really crucial link.
Absolutely vital. Stablecoins, like Tether, play a fascinating dual role in this whole transition, according to the analysis.
What's the first role?
First, they are massive buyers of U.S. government debt. Tether is cited as the 17th largest holder of U.S. treasuries.
Wow. So a crypto company is propping up U.S. debt.
Effectively, yes. They issue stablecoins, take the fiat, buy treasuries, earn the yield, and potentially use that yield to acquire more hard assets like Bitcoin, closing the loop.
And the second role.
Facilitating capital flight. Stablecoins are seen as a key mechanism for moving huge sums of money out of the U.S. tax system and into, shall we say, more favorable jurisdictions.
Like the Cayman Islands.
The Cayman Islands is mentioned specifically as the single largest holder of U.S. debt overall. Not a nation-state ally, but an offshore financial center acting, as the source puts it, like a giant financial black hole for U.S. debt, often facilitated by stablecoin flows.
So the debt isn't just being held by Japan or the UK anymore, it's disappearing into these opaque structures.
Yeah.
And the political connections of these stablecoin issuers, they seem quite deep.
Extremely integrated is the claim. There's an anecdote mentioned about Tether, Coinbase, and Ripple Labs jointly buying the White House ballroom.
Buying the ballroom. Literally.
That's the anecdote used. Whether literal or symbolic, it's presented as evidence of their deep integration into the political machinery, ensuring favorable regulation, ensuring they can keep issuing stablecoins.
Which in turn helps absorb all the U.S. debt being dumped by other countries.
Exactly. It's all interconnected.
But despite this, seemingly overwhelming institutional control, the sources do mention a kind of global counter-movement, right? Nations pushing back against being vassals of the dollar or the euro.
Yes, definitely. There's recognition, particularly among some central banks and sovereign wealth funds, of the danger of being tied to a potentially weakening dollar-euro system.
Any examples?
Well, nations like Brazil are reportedly exploring building strategic Bitcoin reserves. You see opposition parties like the ADF in Germany actively arguing against the euro structure, wanting more national sovereignty.
And for these players, Bitcoin serves a different purpose.
For them, it acts as a liquidity sponge, is the term used. A place to park national wealth that isn't directly subject to the inflation or political decisions coming out of the U.S. or the ECB. It's a hedge, a way to manage capital flows during this period of intense currency warfare and global restructuring. And this whole strategy by the Proof of Weapons Network to capture Bitcoin, the ultimate sovereign asset, it makes perfect sense when you see the bigger picture. It's necessary precisely because the existing system, the one anchored by the US dollar, is undergoing what the sources call a controlled demolition.
Okay, so let's get the context. This petrodollar system, its origins lie in the failure of the previous system, Bretton Woods, right?
Exactly. Back in 1944, Bretton Woods pegged global currencies to the US dollar, which was supposedly backed by gold.
Supposedly.
Right. By the late 60s, early 70s, thanks to, war spending, social programs, the US had printed way more dollars than it had gold to back them.
So when countries like France started asking for their gold back,
The US couldn't deliver. So in 1971, Nixon officially closed the gold window, defaulted on that promise. But the U.S. still had its 8,000 tons of gold and needed a new way to keep the dollar dominant globally, to keep the debt-based system running.
enter the petrodollar.
Yeah.
The deal with Saudi Arabia. What was the core agreement there? It lasted for decades.
It was a strategic masterstroke, really. The
Yeah.
U.S., through the Proof of Weapons Network, offered basically unparalleled military protection and weaponry to the Saudi royal family.
And in return,
Saudi Arabia agreed to two absolutely critical things. One, price all OPEC oil only in U.S. dollars. This forced any country needing oil, which was everyone, to first acquire dollars. Huge structural demand.
okay. And the second part.
Two, take the immense profits they made selling oil, the petrodollars, and recycle them back into buying U.S. Treasury bonds, effectively lending the money straight back to the U.S. government.
Fueling U.S. spending and debt creation.
Precisely. And it worked incredibly well for a long time. The Gulf countries accumulated something like $5 trillion in wealth under this system.
But that system has broken down now, hasn't it? The dynamics have flipped. The U.S. is energy independent, relatively speaking, and China is the big oil customer now.
The pivot is undeniable, and according to the sources, it's managed but irreversible. The petrodollar's grip has slipped significantly. It used to be nearly 100% of oil trade, and now it's maybe 70% dollar, 30% yuan, and that yuan share is growing fast.
And the Gulf countries, Saudi Arabia, the GCC, they're looking east.
They have to. You align with your biggest customer, which is China now, part of the BRICS bloc. The old deal U.S. security for dollar pricing just doesn't hold the same value when the dollar itself is perceived as weakening and your main trading partner uses a different currency.
This shift leads to this really interesting idea mentioned in the sources, the dollar milkshake theory in reverse. How did that work? How does that $5 trillion pile of Gulf wealth suddenly become a liability.
Right, so the original dollar milkshake theory was that a strong dollar would suck capital into the U.S. What we're seeing now, or what the sources argue we're seeing, is the reverse because of a weakening dollar and the changing oil trade.
How?
Most Gulf countries have pegged their own currencies to the U.S. dollar for decades. Now, as the dollar weakens globally, and as more of their oil revenue comes in non-dollar currencies like the yuan, their central banks face a huge problem defending that peg.
They have to intervene in the markets.
Constantly. To keep their currency pegged to a weakening dollar, they have to sell their reserves, specifically their gold or their huge stash of U.S. Treasury bonds, just to buy dollars and maintain the peg value.
So holding dollars or assets tied to dollars becomes a massive drain.
It becomes an accelerating drain, yes. It forces them towards depegging, which itself further weakens the dollar's global standing. It's a feedback loop driving the managed transition away from dollar dominance.
And they're kind of forced into this because the U.S. itself is in an impossible fiscal situation. Let's talk about the U.S. debt numbers that are driving this controlled demolition.
The debt is really the elephant in the room, the core driver of this global reset. U.S. national debt is currently around $38 trillion.
Which is enormous relative to the economy.
It's about 125% of GDP, and the projections cited put it on track to hit 140%. The critical point the sources make is this debt cannot be paid down in the conventional sense. Trying to actually repay $38 trillion would trigger an economic implosion. It would destroy the entire debt-based structure.
And just servicing the debt, the interest payments,
Are now astronomical. Interest payments alone are around $1 trillion a year, roughly on par with the entire U.S. defense budget. It's consuming more and more of the government's tax revenue, squeezing everything else.
Now, the Federal Reserve seems to be signaling it can't just keep printing money indefinitely to cover these deficits. This pushes the system towards something called fiscal dominance. What does that actually mean for us, for the listener?
Fiscal dominance basically means the government's spending needs driven by, the financial complex, the military lobbies, political promises, completely overwhelm monetary policy. The Fed might want to tighten policy or stop printing, but the Treasury needs to issue massive amounts of debt, and someone has to buy it.
And if the traditional foreign buyers, like China or Japan, are selling U.S. debt or buying less, who becomes the buyer of last resort?
This is a crucial point in the analysis. The American populace itself. The debt is essentially being nationalized.
How? Where is it being funneled?
Through pension funds, your retirement savings. Through university endowments. Through student loan structures. And, as we discussed earlier, through the stablecoin system acting as a conduit. The debt is being dumped onto the U.S. private sector and the American people.
And there are specific mechanisms being used to make this happen, essentially forcing people's savings to subsidize the government.
Yes, and this is described as a key wealth extraction mechanism. The goal is to force the rollover of huge amounts of short-term government debt at artificially low interest rates.
Lower than inflation.
Often lower than real inflation, yes. By keeping these short-term rates suppressed, the government can refinance its debt cheaply. But it means that pension funds, retirement accounts, savings accounts are forced to buy these treasuries that offer a yield below the real rate of inflation.
So the purchasing power of those savings is actively being eroded over time.
Exactly. It subsidizes the government's continued debt accumulation by effectively stealing value from savers and retirees. It makes it incredibly hard for the average person to just keep pace with inflation, let alone build wealth. The system is eating its own tail, consuming its future.
Which brings us to what the sources describe as the catastrophic endgame for the current dollar system. What are the only paths left?
It faces a grim choice, according to this analysis. Option 1 is massive austerity / domestic spending, think Medicare, Social Security, and continue forcing the private sector to buy government debt at low rates, which just crushes pensions and savings further.
Politically very difficult, if not impossible.
Extremely. Option 2 is to basically inflate the debt away, keep spending, keep the fiscal dominance going, and let inflation erode the real value of the $38 trillion mountain of debt.
Which seems to be the current path.
That appears to be the path of least resistance, yes. But both options are ultimately catastrophic for any assets denominated in or tied closely to the U.S. dollar. This managed decline, this regionalization of the dollar, is structured, the sources argue, to benefit those holding hard sovereign assets, gold, silver, self-custodied Bitcoin, while everyone else tied to the dollar system effectively becomes the collateral.
Okay, so the economic backdrop is this controlled demolition of the dollar system. Now let's tackle the central geopolitical claim from these sources. this whole U.S.-China trade war narrative. It was never really about trade. It was a managed reset.
That's the core argument, and it really reframes the last, 5-6 years of headlines.
Yeah.
The fundamental point is, because the U.S. economy runs on debt, it must run a trade deficit. It has to import more than it exports to send dollars out into the world to service that debt system.
So tariffs, they weren't really a weapon against China's economy.
Not primarily, no. The sources argue the tariffs were first and foremost a tax levied on small and medium-sized American businesses that relied on imports.
The tax on American businesses. That sounds counterintuitive. How did that actually benefit the proof of weapons network, the big players?
Think about the effect. Increasing the cost of imports via tariffs put immense financial pressure on smaller U.S. companies. Many couldn't compete. This accelerated bankruptcies and, crucially, mergers and acquisitions, M&A.
So the big fish eat the little fish.
Precisely. The only companies that could easily navigate or bypass the tariffs were the huge multinational corporations, the ones with factories in both the U.S. and China or other countries. They could just shift production.
Consolidating their market share.
Yes. And at the same time, those tariffs pushed other export-dependent countries, maybe in Southeast Asia or Latin America, who could no longer affordably sell to the U.S. closer to the BRICS economic bloc, closer to China.
So the network profits both ways.
Mm-hmm.
By consolidating domestically and investing in the regions pushed away by U.S. policy.
That's the interpretation. The banks and multinationals orchestrate the policy, then profit from the resulting shifts in global trade and investment.
Okay, let's break down the specifics of the recent U.S.-China trade deal announcements. The sources say these 5 key points reveal the real agenda, serving the network, not the public. First up, reduced fentanyl tariffs.
Right. The tariff on fentanyl precursors was cut to 10%. This is presented not as a win in the fight against drugs, but as strategic narrative building.
A narrative for what?
As the U.S. military-industrial complex pivots away from the Middle East and maybe scales back in Asia, it needs new justifications for spending, new theaters. Latin America and Europe are targets. The narrative, China is poisoning us with fentanyl, echoing maybe the old opium wars rhetoric, helps justify future interventions, future spending in those regions.
And conveniently distracts from other potential sources or routes for those drugs.
The source explicitly suggests it masks historical CIA involvement in global drug trafficking, used to fund black operations and maintain control. It's about setting up the next conflict or justification for spending.
Okay, second announcement, the overall tariff reduction.
Tariffs were lowered, but only from an average of 57% down to 47%. While it's a reduction, 47% is still incredibly high.
Still painful for businesses.
High enough to continue bankrupting many remaining medium-sized American businesses that rely on imports. This sustained pressure also fuels domestic inflation.
And that inflation serves a purpose.
Yes. The inflation becomes the excuse the financial complex needs to argue for lower interest rates, to facilitate the cheap rollover of that massive short-term government debt we talked about, dumping it onto pensions at subsidized rates. It all connects.
Third point relates to the tech side, restrictions on NVIDIA chips.
Right.
This feels like the heart of the AI arms race narrative.
It is, but the source argues the U.S. is playing a complex double game. On one hand, the government maintains the public narrative of conflict risk, say over Taiwan, because that justifies printing trillions for the military-industrial complex for weapons sales.
Right.
But on the other hand, the proof of weapons network, the financial players, want China to actually keep buying high-end NVIDIA chips because NVIDIA is now this colossal, multi-trillion-dollar entity integral to their portfolios.
But China's pushing back, developing its own chips.
China's resisting, building its own supply chains, partly due to existing sanctions like on TSMC in Taiwan. The real underlying battle isn't just chips. It's about who controls the future of AI development and, critically, the rare earth minerals needed to build and run all that AI hardware.
And that brings us to the fourth point, which the sources flag as definitive proof the trade war was never real. The removal of obstacles related to rare earth minerals.
This is presented as the absolute linchpin. The claim is blunt. The United States cannot run its advanced military programs, cannot build its modern weapon systems without access to rare earth minerals processed predominantly in China.
And also Russian uranium for nuclear capabilities.
And Russian-enriched uranium, yes. The fact that the trade deal explicitly involved removing obstacles to accessing these minerals proves, according to the source, that the conflict narrative was primarily for public consumption, geopolitical reality and dependency force cooperation behind the scenes.
Because China, through its Belt and Road Initiative and partnerships in Africa and the Middle East, essentially controls the supply.
It holds the keys to those critical resources. The U.S. needs them, so cooperation, not conflict, is the operational reality, regardless of the headlines.
Okay, and the fifth point, collaboration on Ukraine.
This is described mostly as symbolic, a staged performance for when the time is right. Collaboration means the U.S.-China will jointly announce some kind of resolution to the conflict, but only after several conditions are met.
What conditions?
One, Europe needs to be fully integrated into the U.S.-NATO military and financial structure vassalized, as the source puts it. Two, Russia needs to have secured control over the strategic mineral resources it was aiming for in Ukraine. And three, crucially, BlackRock and the other big financial players need to have secured the lucrative contracts for Ukraine's eventual reconstruction.
And then the announcement is timed for maximum market impact.
Exactly. Timed perfectly by Xi Jinping and whoever is U.S. president at the time to create a positive news event that pumps the stock markets, benefiting the financial complex.
This whole picture, tariffs driving M&A, AI being pushed as deflationary while causing job losses, it seems to have a very real, very harsh impact on employment in the West.
The layoff numbers cited are stark, and they illustrate this K-shaped recovery perfectly. The financial class and asset owners do incredibly well, the stock market hits new highs, but the labor class faces structural decline.
And it's being framed as efficiency.
It's often framed as efficiency gains from AI and robotics, which allows companies to cut costs and boost profits, further accelerating structural unemployment. The scale is huge. UPS reportedly cutting 40,000 jobs, Amazon maybe 30,000, Intel 24,000, even after getting billions in GTPS Act subsidies, Nestle 16,000, Accenture 11,000.
And these aren't just manufacturing jobs, right? Accenture, that's consulting.
Exactly. White-collar jobs are increasingly vulnerable. The source specifically mentions consulting roles at places like PwC being replaced by tools like ChatGPT. The economic pain of this global reset is being shifted downwards onto the workforce.
So we've got the economic imperative for this global reset, the controlled demolition of the old system. Now let's look at how the proof of weapons network allegedly manages geopolitical crises and uses media attention to gain leverage. The sources start this section by analyzing the Gaza ceasefire.
Right. The analysis presented is that the ceasefire is likely to hold, not necessarily for purely humanitarian reasons, but because it signals the strategic end of the so-called Greater Israel Project.
Which was really a proxy for.
A proxy for the larger American military-industrial complex project in the Middle East. The argument is the U.S. is withdrawing strategically from the region. With the petrodollar system declining, the utility of perpetual conflict there, which arguably helped prop up dollar demand by preventing regional economic integration, is over.
So what happens to Israel itself in this scenario? And what about regional stability?
Israel, in this analysis, becomes what's termed a toxic asset on the proof of weapons network's global balance sheet. Its strategic importance diminishes. Meaning, its national assets are likely to be privatized, sold off, and acquired strategically by the rising regional powers, the Gulf countries primarily, who are now cooperating more with Egypt and Jordan.
Is there an example of this?
The source mentioned a major Israeli steel firm facing bankruptcy after sanctions from Turkey, with the expectation being a bailout or acquisition potentially by the UAE. The trend is towards the region unifying around its own security structures and economic links, trade rails aligned more with BRICS and China than with the old U.S.-centric model.
Okay, so the Middle East conflict cools down, the U.S. pivot away continues, and then almost immediately the global media spotlight swings dramatically towards Sudan. Why the sudden intense focus there now?
This media pivot, you see it across the UN pronouncements, Al Jazeera, coordinated Western protests, is interpreted as a clear signal. A signal that a major geopolitical shift is happening, and that the proof of weapons network is actively seeking leverage, particularly in its negotiations with the increasingly powerful Gulf Cooperation Council, GCC.
Leverage over what? How does focusing on Sudan achieve that?
By focusing on the conflict and the humanitarian crisis there, the network gains a kind of moral high ground, a bargaining chip that it can use in discussions about resource access and regional influence.
Okay, so let's follow the money in the conflict in Sudan itself. It's essentially an internal fight. The Rapid Support Forces, RSF, against the Sudanese Armed Forces, SAF.
It's an internal power struggle, yes, but significantly amplified by external backers fighting over Sudan's resources. At the heart of it is control over valuable rare earth minerals crucial for the AI and tech sectors we discussed, and also Sudan's significant gold reserves.
And who's backing whom?
The RSF, the militia group often accused of atrocities, is reportedly backed primarily by the UAE, who are seen as wanting direct control over those resources. The SF, representing the more established government forces, receives support from Saudi Arabia and Egypt, who perhaps favor a more stable, state-controlled situation.
So it's a proxy war between Gulf powers, essentially, playing out in Sudan.
Largely, yes, and it's happening on strategically vital territory that sits along a key potential BRICS corridor connecting African resources to China via the Belt and Road Initiative.
So how does the U.S. and Western media focus become leverage? By highlighting the alleged crimes of the UAE-backed RSF, things like stealing gold and selling it in Dubai.
Precisely. If the proof of weapons network, operating through its political arms like the UN, can generate widespread outrage about the crimes against humanity committed by the UAE-backed militia,
It puts pressure on the UAE.
it gives the network immense moral credibility and leverage in closed-door negotiations with the entire GCC bloc. Negotiations over future access to those critical rare earth minerals, over the structure of trade routes, over the terms of the U.S.-European withdrawal from Africa.
So it's not really about saving Sudan, it's about securing favorable terms for the network as the old powers leave and the new powers BRICS, GCC takeover.
That's the cynical but perhaps realistic interpretation offered by the sources. It's positioning for the next phase, ensuring the network still gets its cut, even as the geopolitical map is redrawn and Africa's resources are increasingly aligned with the Belt and Road.
All right, this brings us to the synthesis. Drawing from that in-depth Capital Cosm interview, it paints a picture of a global control structure, this proof of weapons network, that operates above national laws. Let's just quickly reiterate that hierarchy.
Yeah, the hierarchy described is very clear and quite stark. At the absolute top are the asset managers and private equity firms, the financial industrial complex, FIC.
BlackRock, Vanguard, State Street, the private equity giants.
Exactly. They exercise control because they control the board seats of the world's largest corporations and banks. Those boards control the executives, the CEOs.
And this structure's power is greater than any single government.
That's the claim. Greater than the U.S. government, the EU, China. This hierarchy is what ultimately dictates the grand strategy, the managed decline of the dollar, the capture of assets like Bitcoin, the orchestration of geopolitical shifts.
What's particularly disturbing in this analysis is the idea that the tools used to control populations and extract wealth in the global south for decades are now being turned inward on citizens in the West.
Yes, this is a major theme. As the West's ability to extract wealth from abroad diminishes with the rise of BRICS and multipolarity, the argument is that the weaponized systems are coming home to manage the domestic population and the social fallout from this K-shaped economic divergence.
What kind of tools are we talking about specifically?
Well, the obvious one is the expansion of the surveillance state. Things like Palantir's data analysis capabilities becoming more ubiquitous, beta tests of digital IDs like those seen in the UK, the push towards central bank digital currencies, CBDCs, which offer unprecedented control over individual transactions.
And even social credit type systems.
Even nascent social credit scores, perhaps implemented through platforms like X, formerly Twitter, where the source notes you might have freedom of speech, but not necessarily freedom of reach if your views don't align. These are all seen as tools to manage dissent and control behavior as economic hardship potentially increases for many.
Beyond digital surveillance, are there physical control mechanisms being put in place? The sources mention things related to border debates.
Absolutely. The analysis looks past the surface-level debate about open versus closed borders. It focuses on the infrastructure being built and deployed, namely the expanded use of the privatized prison sector and the increased domestic presence and normalization of agencies like ICE, Immigration and Customs Enforcement.
So the argument isn't about immigration policy itself, but about
having militarized police forces readily deployable across the country. As the K-shaped economy worsens, financial elites getting richer, working class losing ground, potential for unrest grows, this pre-positioned infrastructure can be used to manage and suppress that dissent, using tactics perhaps previously reserved for overseas populations.
Okay, let's try and connect this to the political narratives we see. The sources offer a specific and definitely controversial interpretation of someone like Donald Trump's role in all this. What's the real Trump agenda, according to this view?
The analysis claims Trump isn't primarily serving the interests of the old neoconservative establishment, the traditional military-industrial complex focused on foreign wars and interventions.
He's working for a different faction.
He's seen as working for the financial and technical industrial complex, the asset managers, the private equity firms, the tech giants who are focused on restructuring and acquiring assets within the U.S. and managing the domestic population during this decline.
So he's a tool for the forces managing the controlled demolition domestically, rather than the old guard focused overseas.
That's the interpretation presented. He's seen as the political figurehead needed to facilitate this shift, this managed decline and regionalization, ultimately benefiting the very top of that proof of weapons network hierarchy.
Okay, let's bring this entire complex analysis back to the listener. For someone trying to navigate this, trying to understand this profound structural shift, what's the actionable takeaway? What's the plan?
The overarching message is definitely sobering, but it's also presented as empowering if you understand the game. The managed decline of the West, particularly the dollar system, is seen as accelerating. But within that chaos lie significant opportunities if you are positioned correctly, primarily by holding sovereign assets.
Okay, so what are the concrete steps for protection and preparation advised by these sources?
Protection boils down to one thing. Secure hard sovereign assets now, and critically, hold them yourself. That primarily means physical gold, physical silver, and Bitcoin held in self-custody where you control the private keys.
The key is avoiding that institutional capture we talked about earlier, avoiding having your assets tokenized.
Exactly. You must resist the lure of handing your sovereignty over to Wall Street ETFs or other structures where your asset becomes effectively a collateralized debt obligation or CDO within their system.
A CDO,
Yeah.
meaning my asset is just part of the collateral backing their debt games.
Precisely. It means your financial future is still tied to the success or failure of their debt-based system. If that system implodes, your claim might be subordinated or wiped out. Preparation, therefore, means developing an escape plan.
Financially and maybe logistically.
Both. Financially, it's about shifting away from dollar-denominated paper assets towards those hard, self-custodied assets. Logistically, it might mean thinking about location, jurisdictional diversification, developing skills. The goal is to be on the right side of this change, to be a principal owner of real assets, not just a piece of securitized debt on someone else's balance sheet. Hashtag tag tag how to track how to.
Wow. That was an incredibly dense and detailed breakdown of this global reset narrative. I think the core lesson we've extracted from the sources today is pretty clear. The U.S.-China relationship, the trade deals, it's not really about trade in the way we normally think. It's about a managed strategic shift towards a multipolar world.
Driven entirely by the financial interests of this overarching proof of weapons network. They're looking to consolidate control, extract wealth through debt mechanisms, and use geopolitical crises like the manufactured pivot to Sudan purely as leverage in their negotiations.
And what stands out most to me, perhaps, is how explicitly the sources claim these tools of control, the economic pressure, the media narratives, the surveillance tech honed overseas for years, are now being systematically turned inward, aimed squarely at managing the populations of Western nations through this transition.
Yeah, managing the fallout from the very system they engineered. The extraction mechanism is now targeting domestic pensions, domestic savings, to compensate for declining opportunities abroad.
So let's leave our listeners with this final thought, drawing directly from the implications of this analysis. If this proof of weapons network is actively extracting wealth from your pension fund by forcing it to buy subsidized government debt at negative real yields, and if AI is accelerating job losses that impact your security, what specific tangible action can you take, maybe even this week, to begin transitioning your own savings, your own portfolio, away from being just another dollar-tied asset, another potential CDO, and towards becoming truly sovereign? Where do you really sit on that K-shaped economic curve? And are you preparing to own assets or to be collateral?